the U.S. forces have already destroyed about 90% of Iran's 8,000-ish naval mine inventory. The other aspect of this that I also want to highlight is that media coverage says the Pentagon told Congress that it's going to take 6 months to fully clear the Strait of Hormuz of Iranian mines. Does not matter. It's only clearing a safe export pathway through the strait. And so that's the timeline that actually matters, not 6 months to clear every mine out of the strait. You just need safe export pathways. And so I think this week's data also supports that theme, is that there is increasingly confidence that the U.S. blockade and just having U.S. forces there is having a positive effect. Iran's capabilities to cause mayhem has been severely diminished. Welcome to the Energy Desk, a podcast from Mobius Risk Group. In this series, we break down the macro forces and fundamental trends shaping global energy markets. We cover everything from geopolitics and policy to supply, demand, and the price risks that we're watching behind the scenes. Each episode is designed to cut through the noise and give you clear, actual insight into what's driving today's energy landscape and what it means for what comes next. You can follow the show wherever you get your podcasts. You can share feedback or ask questions by emailing podcast@mobiusriskgroup.com. Let's get started. All right, Mohit, we're back on the Energy Desk after a little technical difficulties with our last recording a couple weeks, but it gives us time to let some things develop in the world, and a few more uncertainties resolved and a few more uncertainties added, maybe. But
for sure.
Yeah, so I think it's
the oil market for you, right?
That's the oil market, exactly. So I think it's probably going to be about 6 weeks-ish since our last published recording anything on the crude market. But yeah, how's the week going down in Houston, and how's it going in the Mohit world?
It's been pretty good. Mohit world's doing fine. My younger daughter just graduated, you know that.
Congratulations.
Thank you. But in terms of what we're seeing down here, it's getting hotter. I think you're starting to see the bits of summer coming in.
Yeah, it's a perfect cue for another Drew Boyce conversation one of these days as well. So yeah, I think today we'll keep it kind of crude centric and a little bit of the macro commentary that we typically highlight in relation to the crude complex. But yeah, it's been definitely an eventful 6 weeks, kind of just thinking from the lens of the ears, I should say, of the listeners who have listened to our previous episode. But really, since the end of March, what we've been I guess there's so many things. I'll just kind of keep it high level. But ceasefire, U.S.-Iran ceasefire, generally in enforcement since April 7th. You have the IEA coordinated stock release that we already touched upon in that episode. But there's a few more details on that. It's 426 million barrels. Contribution from the U.S. as part of that is 172 and change. And we'll get into more of the data details for that. And now the U.S. policy in place of the kind of direct kinetic warfare side is now more of a blockade, economic leverage with the economic theory sanctions, and just an indefinite ceasefire while they enforce that blockade, and really just putting the Iranian economy under pressure. And so we've seen some interesting stuff from that we'll get into as well. We'll touch on some stuff related to the UAE and OPEC, former member of OPEC as of May 1st, and what that really means for the mid and long-term outlook for the market. And then I think it's probably worth chatting about some of the Trump G meetings that happened this week, or some of the details that maybe didn't come out of that so far, and go from there. But where in there do you think you want to start?
Let's start with the indefinite ceasefire and indefinite blockade, because I think that's a really smart move. You don't have then we're going to war and we are anti-war. We really don't want another indefinite war. And at the same time, you're not spending crazy amount of money on munitions and loss of life as well, right?
Right.
And here you're really forcing them to come to the table, because if they can't export, then their tanks get full. And now they are in the same boat as they had put the rest of their neighbors in. And I think besides the fact that no money is coming in, they're going to rapidly run out of space to put the oil, and then it becomes more interesting.
Yeah. Yeah. And that's something that we're already seeing in the episode that did not get released. At that point of the week, we were kind of end of April having that conversation. At that time, the outlook was that there's going to be between 2 and 4 weeks of storage capacity remaining, even accounting for the decrease in production that was already beginning to be implemented. You had about 2 to 4 weeks of storage capacity before they were going to be totally saturated. And they're already looking for kind of these emergency storage opportunities with either tankers that, could be pretty holy, not in the biblical sense, in the actual whole sense, and just kind of emergency storage anywhere that they can put their crude. And in the 2 weeks since that conversation, we've gotten some more evidence that it is most likely at the point now where they're pretty much full. Kharg Island, so Kharg Island is their primary export terminal, handles about 90% of their exports. And this entire week, we did not have a single loading visible on satellite imagery. And in addition to that, all of our best available metrics for storage on Kharg Island suggest that island's tanks are totally full. So the evidence suggests that from the oil perspective, they're reaching that emergency threshold, which is going to be a massive point of leverage in negotiations and severely limit the kind of what we've seen so far is the IRGC-led delay tactic, just delay, make some public threats, act confident in the public media, and then continue threatening everybody around you, that kind of commentary. But as you get the economic capabilities to be a little bit more strained. And just for context, based off of some of the better numbers that we've been able to find on this, it's still not a great picture, but roughly 60 to 70% of Iran's total revenue comes from oil sales. So that's going to be a pretty big portion of what they're able to sustain. And as they're not able to pay members of the IRGC or their security forces, anything like that, all of this starts to bleed through. And we've already talked about the depreciation of their currency, but that's basically been cut in half since the start of the conflict. And so now it's, if you read it on, the Google currency translate, $1 is 0 Iranian reals. So pretty significant there. And I think that's going to be an interesting one on the heels of the Trump-Xi conversations that we had, even though there weren't any really meaningful public kind of details that emerged from that. What were some of the takes that you had, if any, from that meeting this week?
I mean, the main thing which I would highlight is just both of them agreeing that, Iran should not have nukes. I think that's for them both to come out and say that, or to have that inferred, I think that's a positive.
Yeah, I thought that is interesting, and obviously it needs more confirmation because none of this is a certitude, but thought the just interesting note was that China wants to continue its purchases of Iranian crude, but in that conversation, it's obviously multifaceted dialogue between the U.S. and China, which some can argue. I often can argue that this conflict between the U.S. and Iran is in some ways a proxy conflict between the U.S. and China because of China's historical role in sponsoring the Iranian regime. Same thing that we saw with Venezuela. And as you saw in these meetings, just as kind of an interesting geopolitical side note, one of the more staunch or confident statements from President Xi was that thought that the Taiwan issue was going to be, obviously we've known this, but the Taiwan issue would be the potential conflict point for the U.S. and China. And to mitigate the risks of a direct conflict between the U.S. and China, if you have better leverage over their import supply chain, which they get most of their crude from Iran and the broader Middle East, then you're going to be able to at least dissuade that type of stance. So just kind of an interesting one. But moving on, I think the other one that we highlighted in our conversation, which funny enough, we got confirmation today, was the UAE exit from OPEC and their interest in developing alternative export routes from the ability to bypass the Strait of Hormuz effectively. So anything that you want to comment on that, and I can add some data commentary in there as well.
Sure. I mean, both the Saudis and UAE have known for a long time that their risk is the closure of the Straits of Hormuz. So both of them had developed the pipelines to bypass the strait for about half their volumes at least. And I think what's going to come out from here is really more of an acceleration of the same. And I know you and I were talking, I mean, there's no reason why they can't then offer up capacity to their neighbors and say, hey, you guys want to be piggybacking on these pipelines too. A, we get money and you get surety of your supply getting out.
Mm-hmm.
And I think over time, the choke point may become much less of a choke point.
Mm-hmm.
And I think that's good for the region anyway.
Good for the region, obviously good for global economy. Yes. So for some of the underlying context, the development today was that the UAE, and this is something that they've been working on already, but the UAE confirmed that they will be doubling the export capacity through the pipeline to Fujairah. So right now it's kind of a 1.5 million a day, steady state, 1.8 on kind of an emergency capacity rate. And they're going to try and double that to that kind of 3 to 3.5 mark by next year. So they've already started the construction, and they're going to aim to have that completed by 2027 and operational, of course. So that will be definitely pretty interesting because as part of this kind of background, obviously the UAE exit from OPEC on May 1st. There's many signals to take from that. One, though, I think is the kind of broader alignment or interest in getting that foreign investment in all aspects of the UAE's economy, but especially around energy and data centers and some of these interesting aspects of what they're doing. But then the other side, having more ownership over their energy future. And so they put a bunch of investment in to their infrastructure already. They got their spare capacity, or total production capacity rather, up to about 4.2, 4.5 million a day for crude this year. And they're going to try and get that up to 5 million a day by next year. So definitely will be an interesting one. And as part of their OPEC relationship, something that we've highlighted before, but worth highlighting again, is that that's been a long running issue between the UAE and OPEC, but really the de facto leader of OPEC, Saudi Arabia, where they've been having to sacrifice all these investments that they've put into their production capacity. And have to produce, they got 100,000, 200,000, 300,000 here and there, but they're producing 3.4 million a day when they could be producing, almost a million more than that. And they have to take capacity from African producers as kind of an exchange of capacity just to maintain that steady state. So no longer. What are some of the other interesting thoughts that you have about the UAE's exit and what that really means for either the UAE or broader kind of OPEC conversation?
Yeah, I'm going to say this more as a joke, but maybe they were listening to our conversation, the one which did not get published. And so they announced today that they're doubling the capacity. Okay.
You never know.
But yeah, in terms of longer term, I mean, as you get more capacity coming out through there, the stark sort of contrast between Iran and the UAE has been, one has used their oil wealth to really attract capital, become very much more free market and grow, while Iran's kind of just been following I'm going to build weapons, I'm going to be getting to be more militarily strong and threaten all my neighbors. So progress versus non-progress. And I think if I take a step back, I think what's going to come out from here is you'll get more stability in the region, given how the UAE was actively defended by Israel with their Iron Dome and people, and effectively, protected against Iranian barrage of missiles and whatever drones. And I would expect more Abraham Accord type things to be signed, and there to be more peace in that sense. And again, peace attracts capital. Capital then has that positive feedback loop where as you get that peace dividend, that it grows more, and then people tend not to go to war. They say, okay, hey, let's sort this thing out.
Yeah.
And so I think long term, I think this has a much bigger impact. And some of that geopolitical risk in the market will, I think, get lower in the long term. We are talking many years down the road, but I think that's the direction it's going to go.
Right. Even if you're thinking on a decadal timeline, though, the peace dividend, so to speak, of not having an Iranian threat to say 20 to 25% of global crude flows or petroleum liquid flows through the Strait of Hormuz, simply because you're providing alternative export routes or whatever the factors are. Just that premium that has been baked into transactions on a global scale for decades is no longer going to be there. And so that's, I think, a positive thing for the region, obviously. But more broadly, you can think about how that's reflected in airline fares, in our maritime freight costs, everything like that, which ultimately bleeds into every good sold. And so when you remove that premium, that risk premium, effectively you're adding, however incremental it is, you're adding a little bit of stimulus effectively for global economic output. So that'll be really interesting. And then as you highlighted, the kind of broader region excluding Iran, and as we saw with this UAE announcement, I think it'll just be really interesting for, say, Saudi Arabia, as you already mentioned, with, hey, let's increase our east-west export capacity to, 10 million or 14 million, 15 million. And then because you have the proximity to Kuwait and Iraq, who Iraq is also interested in increasing their alternative export routes, they confirmed that they're going to be building out a 2.5 million a day pipeline going north. I believe the port is in Jordan, where that one hits the Mediterranean. And so all of these countries are realizing, hey, if we can, let's just bypass this risk altogether. But what that means for that entire region, I think, is just going to be really interesting to watch over, again, decadal timeline. But bringing it closer in, I think there are some more interesting conversations as well for kind of the near term, medium term, based off of the existing fundamental picture and potential for prolonged disruption there. Who knows? But I think there's definitely some interesting scenarios that we can maybe just chat through as we have been with our clients, and how that is reflected in the forward curve and volatility and some of those different aspects. So on that note, what are you seeing? We'll start with maybe the curve shape and volatility, how that's been evolving kind of in the more recent couple weeks here.
Sure. I mean, so you went from a very flat curve pre-attack to a very severely backwardated curve. So I do remember one of our conversations here, we talked about how month 1, month 2 had become almost $15. And I think at that time we were looking at the May D's, that was $40.
Yeah.
Over time now, it's kind of like maybe a $5 M1, M2 spread roughly.
Yeah.
Depending on which day you look at it.
440 today.
And about a $25 June, Jan, so same time frame spread. So what's happened is the fronts come off some, but the backs have been going up more as people are putting in more of this is not a 30-day problem. It can be a much longer term problem.
Right.
And the longer this does not resolve, the longer that curve has to come up, as in that much of the curve has to come up. So you're seeing some of that. So the opportunities for clients have been, rather than just in the front 3 to 6 months, they've expanded into 27. You're seeing some of that in the increased call skew further out the curve. So some of that risk premium is showing up there. So I think that's a lot of what's going on. And then, of course, a different part of the complex is products, how gasoline and jet were on the top decile 2 months ago, and now they're the bottom decile, and how that's impacting
inventories,
global markets, airlines, cars, you name it.
Yeah.
That's going to become a bigger problem than I think is factored in.
Absolutely. Yeah. As we've highlighted kind of since the start of this, and just in our conversations, of course, this is a product story, not necessarily a crude story. And I think that isn't really appreciated to the extent that you would hope often in kind of broader media commentary. But, as you mentioned there on the inventory piece for distillates, but gasoline as well. So U.S. jet is still, highest seasonal level of the last decade based on last week's print, still healthy. Whereas distillates, which were a little bit lower, they were at the second quartile heading into this. They kind of were low, crept back up, and then now, as of last week, we're back at the 0th percentile relative to the last 10 years seasonally adjusted. So 102.5 million barrels there for the U.S., back to a year-over-year deficit. But the one that's really been incredible to watch is the total gasoline stocks for the U.S., and this is reflected elsewhere, of course. But those are, as you mentioned, they were top decile heading into the conflict. Now we are 10-year seasonally adjusted 0th percentile for U.S. total gasoline. So pretty rapid decline there. And this same theme kind of persists throughout product inventories, as you mentioned, in Asia and Europe, everywhere that has been really hit by that. And that gets into the other aspect of this fundamental S&D equation that you have to reconcile that is not very well counted in the media. There's numbers that get thrown out that can drive you nuts, but the numbers that really matter on that front, demand destruction. So we talked about this before, but kind of the start of the month, we were starting to see some pretty solid evidence for demand destruction in kind of order of magnitude 5 million a day. And from what I'm seeing, that's creeping higher to the higher single digit million a day. And is that pretty similar to what you're seeing as well?
Yeah, I mean, definitely you're pricing out demand. I mean, almost a month ago, we were talking about how physical jet and some of the distillates were trading at between $200 and $300 a barrel in Asia. Asia has been the most impacted. So both from demand destruction, I mean, you're seeing tens of thousands of flights being canceled, $300 to $500 surcharges on international flights. And then I was reading India has recommended everyone work from home for a year. So, I mean, everyone who can is trying to cut demand. And so those numbers are probably still understated. And the thing about demand destruction is it's not a switch. It takes time to cut that demand. But then when you do get the supply back, it's going to take a while for that demand to come back. So that's definitely an issue.
It seems like it's slow, and then it speeds up pretty quickly. It's gathering momentum. Similarly, this week saw in India just anecdotal evidence on the transportation side. A lot of the trucking fleet has been basically grounded because of the various hubs not having enough diesel in this case. So those types of events, as they start to multiply and you get further and further, I guess, more incentives to then curtail your consumption in some capacity, that starts to multiply out further and further. So, you know, in the way that the European Union likes to say, the cheapest form of energy is the one that you don't use. You know, that type of mindset for the European Union. Some of our internal jokes surround that, but you know, I think that's definitely underappreciated. And when you have the arithmetic around what is the actual, I guess, net disruption, the supply deficit or whatever you're trying to calculate on that front, the number that often gets thrown around in the media is they just take this headline number on the Strait of Hormuz flows where, you know, 20 and change for crude, 25-ish for total petroleum liquids. And they just throw that number out like that's the disruption. So one, just most plainly stating that is not the disruption. You have obviously Saudi Arabia rerouting flows through East-West pipeline. We've highlighted that before. That's 7 million a day, a net 5 because they can only export 5 from the West Coast there. And then Fujairah for the UAE, they've ramped that up to emergency capacity about 1.8, a little bit more here and there. So you have kind of those flows getting rerouted. You still have tankers going through the strait, but they're doing it with their AIS transponders switched off. And so that's the other one that you often see in the media, like no tankers cross the Strait of Hormuz today. That's not reality. It's more none cross the Strait of Hormuz with their AIS switched on. And so you start to see that, especially this week, which we'll probably touch on this a little bit, but with the U.S. mine clearing operations that began on April 11th, as they were heading in the doors for negotiations, the 2 destroyers and associated mine clearing forces, et cetera, crossed through the Strait of Hormuz. I thought that was a nice little move. But that process began the second week of April and has been ongoing. And based off of this week's reporting from Admiral Cooper, from the commander of CENTCOM, to Congress, he noted that the U.S. forces have already destroyed about 90% of Iran's 8,000 naval mine inventory. The other aspect of this that I also want to highlight is that media coverage says the Pentagon told Congress that it's going to take 6 months to fully clear the Strait of Hormuz of Iranian mines. That does not matter. It's only clearing a safe export pathway through the strait. And so that's the timeline that actually matters, not 6 months to clear every mine out of the strait, because that is in many ways irrelevant. You just need safe export pathways. And so I think this week's data also supports that theme, is that there is increasingly confidence that the U.S. blockade and just having U.S. forces there is having a positive effect. Iran's capabilities to cause mayhem has been severely diminished. Still a nuisance, still have drones, and there's still risks associated with shipping that will keep insurance obviously at a premium, and that has a negative effect on shipping. But I think it's also just important to recognize that if there is a will, there is a way in many ways for the market, and those molecules will find a buyer if they need to. And you're starting to see that increasingly.
Yeah. And coming back to your point of the reported number versus the real number. So you've got the Saudis going on the east-west, you've got the UAE going through Fujairah, and then you've got the demand destruction. So really, the real deficit per day is way smaller.
Single-digit
part
millions.
of what's being, that's part of what's being the driver of the curve going from that extreme backwardation to more of a flatter, still backwardate, still very backwardated, but flatter, and the backs are going up a lot more. So and I think
still significant, right? Like 2 to 4 million a day of a net deficit. It's still significant, but it's not anywhere close to what the concern was, right? Exactly. And I think that's also been, as more time passes, the other aspect that's feeding into the backs getting a little bit more bid is that you have the IEA coordinated stock release, touched on that. So 426 million barrels, that is going to be happening over time. The refill needs from that is one component. And then you have the other aspect of the floating surplus effectively getting reduced. So there's no meaningful surplus outside of the Persian Gulf. And so that is definitely supportive. As we look at, kind of closer front 3 months of the curve, though, I think it's also important to recognize some of these downside risks that haven't been covered. And I think that's maybe a good opportunity. So, Matt, why don't you take that and go with whatever you have?
Yeah, I think that's the part which, is not focused on. Everyone's still focused on the upside. And when you look at, demand destruction is going to be a slower return. You've got all these barrels trapped in the Gulf. So once you have the ability to get them out, they're 2 weeks away from destination. You also have the continued the IEA barrels coming in. UAE will be able to expand their exports. So you have that. And if you think about positioning, that's another one which can drive the curve down fast because Brent has become long. And if things do stabilize, the first thing will be the longs will exit, and then they'll probably flip and go short because these are very attractive short level. So once you get that sort of ball rolling, there's a lot of potential things which can drive to the downside. Both the curve shape, the price, everything. So it's still early.
It's a little bit like potential energy is just building and building and building.
It's there.
Yeah, I think that is, it's definitely an interesting one. And then, I think the other aspect of what's maybe not refreshed enough in the arithmetic is also non-OPEC production. So all the other supply that's coming online. You've got new molecules coming online from small countries, emerging producers like Guyana. But then also this has been a benefit, especially as the back of the curve gets a little bit more support. That's going to give an opportunity for these higher price producers to lock in a more favorable kind of long-term outlook and increase production accordingly. So that means US, means Argentina, but we're also seeing Brazil aggressively ramp production into this. And so I believe their production's up it's double-digit percentage points year on year. So I think last I looked, might be off on this, have to maybe go back and check, but I believe it is over 4 million a day for total liquids. And so they're increasing quite aggressively. So 1Q26, total liquids, 4.5 million a day. So ramping there, and they're most likely going to get to basically 5.5 by the end of the year, essentially another million a day of liquids there. So it's, take that and you can extend it to other regions as well. So in Africa, anybody who's not disrupted in Africa, Nigeria, Libya's been producing more. And you kind of go down the list, even within OPEC, anybody who's not trapped by the Strait of Hormuz, you get just incremental supplies here and there, and that just starts to add up.
Yeah.
The other piece I think is it's an interesting kind of back and forth with the Russia-Ukraine side of this, because I think I'll just note this so that people are aware. The U.S. sanctions waiver for Russian seaborne crude and product exports, that expires at midnight tonight, Eastern time. So tomorrow that goes back into force. That was 4 barrels that were shipped already. So it's, a little bit of a question there, but their exports got up to 4-week average about 3.6 million a day. At the same time, though, you did have Ukraine, which I think it's a pretty nice way of saying it, but Zelensky calls it their long-range sanctions that they increased, so increasing their long-range drone attacks on Russian energy infrastructure inside kind of these core energy hubs inside Russia. They ramped those aggressively after that U.S. sanctions waiver. So they definitely blunted Russia's ability to ship crude or products from their various Black Sea or Baltic Sea terminals. As we see that waiver expire, though, that creates another interesting one. They might re-up it, who knows? But it seems like at this point, that's not an immediate priority. So that'll be an interesting question to answer. I don't know if you have any thoughts on that, how that affects maybe the Indian Asian purchasers, which is India and China.
Yeah, I mean, on the purchase side, it complicates things a lot for India, particularly since India and Russia have a very long-lasting, close relationship. But the other side, which you raise, is Ukraine hitting all these refineries, even when everything in the Middle East is fine. We talked about at the start of this call, the products are the problem. And that'll become a bigger problem because now you have less refined product coming out of Russia.
Just incremental refined product capacity. So, it's it'll be an interesting one. And I think the other side of that equation, that because of the Middle East conflict, it's kind of fallen into a little bit of the background, but the potential for kind of a back-to-back type of resolution. So if there is pressure, say on the Chinese side on Iran to be a little bit more favorable in that negotiation stance, or regardless of China's influence on that, if there is obviously the effectiveness of the economic pressure from the U.S. side on Iran, if there is some type of capitulation in the near term, then I'd say going back to your downside risk, the double influence there. So the amplification effect of having, on the heels of a U.S.-Iran resolution that reopens the strait, having some type of ceasefire agreement with Russia and Ukraine, which is still in the works. Obviously, the odds of both of those, I would not say, are incredibly high, but it's definitely a downside risk to just keep in mind.
Yeah.
And that would be obviously more of a front-centric factor in many ways as well, obviously sentiment related. So, well, I think that kind of covers all my notes. How are you feeling on what you have there?
Yeah, no, that's pretty much what I had. I think that was great. We covered quite a lot.
Yeah, there's a lot in there, and we can absolutely dig into the details, but we can save that for another time.
Sounds good.
Awesome. Well, thank you, Mohit. And we'll see everybody else on the energy desk. Hopefully get Drew back on here for a little gas conversation.
Yeah, sounds good. Thanks, Al.
All right.
Appreciate it. Bye.
Thanks for joining us on the Energy Desk. Please keep in mind this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.